Hi again.
Hi. So I heard there are different kind of mutual funds as well. What are those about?
Okay, you can compare your mutual funds with playlist depending on your mood, goal. We can choose what is the best, or you can rather choose the best mutual fund which you want to buy.
Got it. So what are my fund options?
Okay, the fund options are broadly divided into three parts: equity based, debt fund, and hybrid fund.
Got it.
Okay, equity is, as you know, the word equity, it's a risky. It gives you high returns and can give you slightly less returns also in the time period. But if you're looking at the long term, equity beats everything. Okay, because high risk, high reward. Then you come to debt funds. Debt funds are ones which one gives moderate returns, less returns, but more or less is a guaranteed sort of return which you can think of getting. And if you go for hybrid funds gives you a moderate return which is not so high and not so low, you know, and it can give you a fairly good returns. But everything is based on something or the other. That's all.
I'm assuming that if debt funds and hybrid funds sound a little more stable, so they are probably there to protect our savings. And say in my earlier life, like in my 20s, it would be better for me to invest in higher equity funds. Is that correct?
Definitely. In your 20s, time is your best friend. And you can look at it where, it goes up and down. It's not going to make a major difference in your this thing. Generally, the ratio is age 100 minus age. Let's say 100 years and I'm aged 25. That generally means that 75% of your money can go into equities. That's the kind of risk which you can take because you have the risk taking ability. There is no responsibility right now on your shoulder, no family, this thing. And even if you lose some money also, it's okay.
You can make it
You
back.
can make it back because you have the age with you.
Understood. So I've also heard about something about fixed deposits. What is that?
Okay. Now, when I've said about equity, that is in your 20s. Okay. But look at it, person who is at the age of 40 or the person who is at the age of 60, their risk taking ability goes down. Okay. Now, as I said, like age 100 minus the age, that means you're putting more in equities and less in debts. Later on, that ratio decreases. So the people who are in 40s, they have the responsibilities also of the family and everything. So their risk taking ability goes down to a certain extent. And for people who are above 60, well, they just want to have a fixed income. But coming up to fixed income is just like a FD, guaranteed, and it is given by banks. Okay. But the only problem with FDs is you cannot beat the inflation.
Okay.
Okay. So generally, the government, the country goes on GDPs, and if the GDP is 7% and I'm earning 5% or 6%, that means I'm earning less compared to the kind of
Money
inflation and the GDP is telling. So lower and lower the risk taking. Today, if I buy something of 100 rupees, over a period of time, it can be 105 also, 107. So the money which I have received is less. I cannot go in and buy same thing again and again because the amount has increased, the price has increased also.
Got it. So mutual funds is slightly riskier, but it's more like pooling your funds together with other investors.
Perfect.
Fixed deposit is fixed returns,
Okay.
but below inflation or like subpar returns, but they're from the bank.
Right.
And it's for a stable income.
Stable.
Yeah. And okay, so then what is insurance?
Insurance, people are looking at in a different way as of now, because the kind of investments, the type of investment, the investment baskets have increased. People think life insurance is for you will get good returns. No, you will not get good returns, because it will give you slightly less returns than what you would have got into equities and everything. Okay. But let's say you have taken insurance for 21 years or 20, 50, 20 years. You just minus the first three premiums which you have paid. Then your returns are the best. Okay. Because they mix. Life insurance is something where you also need returns and where also the risk is also covered. Like let's say for example, I'm just giving you an example. I've took up 1 crore rupees policy for 20 years. I'm paying 5 lakh rupees as premium. Okay. The bonus which will accumulate is also 5 lakhs. I've paid 5 lakhs and I got an interest in a way of bonus as 5 lakhs. So that's 100% return in the first year. But over a period of time, the returns will fall. Now look at it, you invest somewhere else. Let's say you invested 1 lakh rupees and you got a return of 12%. 12% on 1 lakh is how much?
12,000.
12,000. Here what has happened? Let's say for example 5 lakhs. So it is 60 lakhs. 6 lakh rupees would be your 5 lakh rupees will give you a 60,000 rupees interest. But here what LI insurance has given you 5 lakh rupees as bonus. But that is simple interest, whereas when you invest in a compounding way in equities and everything, you get it on a compounding way.
Got it.
That's the basic difference.
Understood.
So I would personally prefer that in the young age, people should take out a term insurance.
Okay. What is term insurance?
Term insurance is the risk which is being covered. Its premium is very low, compared to. And the best thing is that, when you take mutual funds, it goes into the return column, and when you take term insurance, it goes into the risk column.
Okay, got it. So your
So
portfolio is
bifurcating it right now for you.
understood. So if you take term insurance and mutual funds, your portfolio has an umbrella basket of the investments you mentioned.
Perfect.
Understood.
Once the risk is also covered, and here the returns are also covered.
Got it.
Getting my point.
Okay. So maybe if you were 20 years older, would you prefer taking a fixed deposit or still investing in mutual funds?
Today's scenario is completely different. Okay, we have different kinds of baskets for investing, and really speaking, today, even at the age of 20, or let's say I'm at the age of 50, seriously, I would have not looked at equities today. And I'm saying that because whether at the age of 20 or at today's age of 50 or 40, nobody should be really going in for
A fixed deposit.
fixed deposit. And even if you have to go for fixed deposits, it should be in percentage wise.
Got it.
Let's say if you have 100 rupees, you may put in 5 rupees or 10 rupees, 5%, 10%, 15%, depending on your risk abilities.
Understood.
So lesser the risk ability, the more you go into debt funds.
Got it.
And even in debt funds also, I would go into mutual fund debt funds rather than fixed deposits.
Understood. So
Okay,
fixed
because-
deposit is the last.
Last thing. People are looking at in a different way. Okay. They say fixed deposit, I'm getting the money and this and that. but the ratio is 6%, 7%, 5% at times, depending on the segment. And it's for a short tenure, 5
Got
years.
it.
So rather than putting it into fixed deposits, let's go into debt funds and mutual funds. At least you will get a return of more than 7%.
Got it.
You're getting my point.
Yes.
You
Got
can think in that way. It is more or less guaranteed.